Hello, good morning.
So we're working, brilliant. Thanks very much for this. Normally I sort of start off by saying, tell me a bit about your fund and what it's trying to achieve. I think most people will know though, a bit about it, but do you want to just do the sort of quick intro, please?
Yes, certainly. So the Schroder UK Public Private Trust is an investment trust that we took over in December 2019. And that was after a 6-month manager selection process, because the board of the trust had decided to replace the former manager, who was Neil Woodford. So the former name of the vehicle was the Woodford Patient Capital Trust, which was one of the vehicles that he ran alongside the Equity Income Fund. Since we took over some 20 months ago, we have been trying to reposition the trust. We took it over for, I think, 2 main reasons. The first is we did see some interesting companies that we felt that if we could move them in the right direction, they could become very interesting companies. There was a lot of things in there that we were less keen, but there was some that if we could just move them in the right direction, we felt there was some value in the trust. And the second reason we took it over was because an investment trust is an ideal structure for retail investors to access private equity. And we as Schroders Capital and Schroders as a larger organization, we invest in public equity and in private equity. And having an investment trust that would be available to retail investors would allow us to get closer to some retail investors and expand our public-private capability, which to date had been mainly public or private. So that's a bit of background on Schroder UK Private Trust. We also on this page have another vehicle called Schroders British Opportunity Trust, which we actually launched last year, and we had the IPO in December 2020. So we have 2 investment trusts that have public and private content, and I'm co-portfolio manager on each of them. So in each case, we have someone from the private side, which is myself, and someone from the public side. Roger Doig for Schroder UK Public Private Trust and Rory Bateman for Schroder British Opportunity Trust. Now, this slide here shows the recent investments made by the private team into these 2 trusts. So I'll just kind of emphasize it doesn't show 2 things. So it doesn't show the recent public investments. It also doesn't show any older investments that are already in the trust. These are just the logos of the new investments that we've made in the private space. And the reason we put them forward is really to emphasize that there's quite a large spectrum to invest in regard to private companies in the UK. And we cover the full spectrum. We invest in venture, growth, late stage growth and buyout, as well as full buyout. The one thing I'd like to highlight on the 2 trusts that's subtly different is SUPP, Schroder UK Public Private Trust, is a bit more venture and growth, whereas SBO can extend all the way across through growth buyout and also full buyout. As this is a talk about SUPP, we do actually have a couple of slides about Revolut and Tessian later on. So I think we can talk about those at those points. In which case, maybe now we can talk about the last 6 months, talk about what we've done so far this year. The way we talk about the trust is normally on a quarterly basis because we release our net asset value and we do a report every quarter. So we've released the Q2 report, even though we're coming up to the end of in fact, we're now actually in October. We can give you some indication about what's happened during Q3, and with, of course, the big news about Oxford Nanopore, you can make certain assumptions about when we what will be included within our report when we do our Q3 report. But focusing on Q2 on the first half of the year, the financial performance of the portfolio of SUPP was really strong. We were up 16%, and that was driven by 4 main topics. There was a fundraising for Nanopore back in May. We also had an IPO of another company called Immunocore back in February, and we sold stakes in 2 of our businesses, Inivata and Kerr. The combination of those activities allowed us actually to move from a large net negative position of having a large debt on the portfolio to now being in the positive side and having net asset balance that's now above 20 million, which is enabling us to actually make new investments. And this is really where the center of the page is focused on. We're now, after 20 months of running this trust, we're now in a position where we're actually making new investments. And for us as an investment manager, that's a really exciting point because it shows that we've been able to reposition the old portfolio, get some capital out of the old portfolio and start making new investments. But of course, the one big piece of news is Nanopore. This slide was created yesterday, so it still says the potential IPO. Oxford Nanopore did IPO yesterday, and we've got a slide a bit later on where I'll explain a few more words about Oxford Nanopore and what that means for the trust. So I can now show you the top 20 holdings as of June 30th. The number one holding was and is Oxford Nanopore. That will clearly change massively as a result of the IPO. And just to give you some words about exactly how much that will change, because I'm sure people have questions about what we did. The story with Oxford Nanopore is that we sold, so the company was held in our books at about a 2.5 billion value as of June 30th. We had announced before the IPO that we would sell 10% of our stake at the IPO. So the IPO itself was at £4.25 per share, which was actually an uplift from our holding value. And then it had a super first day yesterday and ended up the day above £6. And most reports state that this IPO was one of the most successful UK IPOs of all time. So it's a really good story. Overall, it's very good news for the trust itself, for ourselves as well. To put the numbers in detail, just so you can have them, but I would also say any numbers that we talk about today will be effectively out of date tomorrow and the following day, as the share price of Oxford Nanopore will move in the coming days and months, of course. So we had a 90 million position. The amount that we sold generated about 11 million, leaving a fair value of about nearly 80 million. That fair value of 80 million is now worth some 140 million, plus the 10 million that we have as proceeds. So you can see that the net asset value of Nanopore will have increased by the time we get to our Q3 report. And the other thing I'd like to highlight on this page is...
Just before you go on, Tim, sorry.
Oh, sure. Yeah, go ahead.
So are you locked in on the remaining now? Have you committed to hold them for a certain period of time?
That's a very good question. Yes. So in almost all IPOs, the existing shareholders agree to a lockup of 6 months. There's often conditions around that. Sometimes it's possible to sell a bit before that. Sometimes certain shareholders actually also have a lockup that's longer. The majority of shareholders have a lockup of about 6 months. But I'd also like to say that considering this is such a high quality company, we do have the intention to hold the company for a longer period than that. We may sell a further position at some point in order to make it to be a more suitable size position within our own portfolio, but that's certainly not intended as a negative comment about Nanopore, which we see as a really high quality business. In fact, actually over the last 20 months, we could have sold pieces of Nanopore many times. And in fact, in the financing round back in May at 2.5 billion, we could have sold some pieces there. We chose not to, despite the fact that Nanopore is 25% of our trust, and we chose not to sell because we saw a lot of value in Nanopore. But yes, to be very clear on your question, we do have the bulk of our holding locked up for the next 6 months. I think the last thing I'd like to mention on this slide is the fact that we have now started making new investments. One of those new investments is highlighted in light blue, which is Tessian. The other two on the kind of on the right hand side of Johnson Matthey and Revolut will be in this list in the Q3 report. And I'd like to highlight that over the course of the next kind of 3 to 6 to 12 months, we're going to be making quite a number of new investments, both on the public side and the private side. And people will start to see the kind of companies that Schroders and Schroders Capital really stands for and really likes to invest in. If we take a kind of a step back to look at everything over the course of this whole calendar year, we've broken the work that we've done into 3 sections: portfolio rebalancing, liquidity, and debt payment. I think I'd like to just pull out 1 or 2 points on this slide. The first is the portfolio rebalancing. We did sell a basket of 7 assets to a firm called Rosetta Capital back in March. We also sold our position in Kymab to Sanofi. Now, I think the Sanofi and Kymab story really emphasizes how we work. When we took over this trust, most people did not particularly like Kymab. It was not a company that people spoke about. It was a company that was heading for the path. It wanted to go down the path of an IPO. And one of the things that we say is there's the right path for the right company. And in some cases, it can be an IPO in the US, like Immunocore. In other cases, it could be an IPO in the UK, like Oxford Nanopore. In other cases, it should be a trade sale. And so in the case of Kymab, we really strongly believed that the company was going down the wrong path. And this is what I was meaning about when I mentioned that we saw some companies that were interesting, but we felt we had to move them onto the right path. So Kymab was going down a path where if it went for an IPO, it would have had to go through another financing round, which would in all likelihood have been a down round, and there would have been a lot of negativity. Instead, we worked with the management and with the other shareholders to direct the company to work with Big Pharma and to set up strategic relationships with a number of Big Pharma companies. They actually culminated in a full sale of the company to Kymab. But interestingly, in the summer last year, we scooped up about £1 million worth of shares and because other people didn't necessarily agree with our path. And when we sold Kymab, we made about 8 times, 9 times our money on that £1 million worth of shares that we bought last summer. So by moving a company into the right direction, we feel that we can get a lot more value. And in this case, we've got a good amount of liquidity. The bottom part of this slide shows some comments about the debt. I think the summary here I'd like to say is when we took over the facility, the trust, the trust was about 110 million in debt, where the debt was actually due 1 month later, which is not a good position to be in. We renegotiated that, we extended it for a year, and then we extended it for a second year. The great development now is we've actually paid it all back. So we do still have a credit facility, and we do intend to use it over certain points of time. But the big story here is that this credit facility and the debt facility is not an issue. It is there to be used as we see fit because we currently paid off the whole of the old facility. And that is a material change because the trust itself, many of you will know, was either seen or perceived to be a forced seller 2 years ago because of the debt facility. If you had the trust had to sell assets to pay down the debt. We've now got through that whole phase, and we're no longer or the trust should never be seen as a forced seller. If we sell some companies, it's because we choose to sell them to the right people at the right price at the right time, and we don't have any external kind of pressure on ourselves to sell assets in order to pay down debt because that's now fully been paid. The next slide has a few more words about Nanopore. And as I mentioned a moment ago, this was created 2 days ago, so effectively before the IPO, so it doesn't include the information about the IPO. So a lot of this information is almost a bit redundant now because it talks about how we brought in good high quality investors back in May. The key part now with the IPO is that the IPO priced at £4.25, which was the top end of the pricing range, which was a very positive thing because that was an uplift on our books. But even more importantly, it was one of the best ever London market debuts, and it closed the day 44% up at £6.13. I've not checked the price today. I'm sure there's going to be a bit of a journey in the coming days and weeks. But I think that the really important topic for us is that we always said this would be a materially important company to the trust. It certainly has been and is. At the moment, it's not reflected in our net asset value. It will become reflected in our net NAV when we release our NAV for the Q3 period, which should be at about the end of November time.
It's going to be quite sort of a big position within the portfolio. Is there sort of an ideal level for the exposure to one stock?
Yes, that's a really good question. So our strong belief is that when you build out portfolios, you should relatively equal size your initial investments. So we've said that all of our initial investments will be between 5 and 10 or maybe 15 million pounds. So we don't want to make new investments of 1 million and then 2 days later make a new investment of 50 million because we don't think that's such good portfolio construction. So that's on the new investment perspective. With regard to the holding position, it's obviously great news if a company grows. And in the case of Nanopore, it's up 44% in a day. So that's always a very strong and positive sign. But there is a threshold to which that we don't want the portfolio to be too dependent on one stock. So we will be, this is actually why we sold 10% of Nanopore in the IPO, despite being confident of the IPO. It really is a matter of portfolio balancing. And over time, we will trim that down a bit, because if we end up having kind of the whole portfolio being dominated solely by Nanopore, then investors would really have the choice of choosing Nanopore instead of this. What we'd like people to do is see that they can get Nanopore through the trust, but also have a lot of the other options like Revolut, Tessian, and all the public companies that we're also making as investments. So I haven't given you an exact threshold, but really 25% was the top end of where we felt comfortable with. There's certain dynamics now, as this is a bit of a legacy portfolio that we're transitioning to be a fully Schroder's new investment perspective, but we're going through that journey at the moment.
Before we go on to talk about some of the new investments, can we just go back to here? Wait, too far. You wrote down the value of Rutherford Health, which is one of the ones you inherited from Neil. Can you talk a bit about what you think the prospects of that business are, please?
Yeah, certainly. I mean, there were a number of companies that have been valued down since the former manager ran the trust. So Benevolent, for example, was at one point valued at 2 billion. It's now valued a lot lower. So there's a number of companies, same with Atom Bank as well as Rutherford Health. So what I'd say now is we feel that the valuations of the companies in the portfolio are appropriate and fair valuations. There's always a lot of people who've questioned what we thought of the valuations before we took over the trust, and in many of these investor update meetings, people have asked us, what do you think? We say now that the portfolio companies, we said for a while that in aggregate, the portfolio was fairly valued because we knew of the great upside potential of companies like Kymab and Nanopore. What we now say is actually not just on an aggregate basis that it's fairly valued, but most of the individual lines are fairly valued. So we think the current price for Rutherford is a fair valuation. It's quite interesting because Rutherford itself could have a great future. It provides cancer treatment or cancer therapy for people with cancer, and it provides proton beam therapy, radiotherapy, and chemotherapy. And with all the challenges that the NHS have been through in the last couple of years, there has been and there will be a trend towards more private companies providing more solutions and more treatments for people. And Rutherford is ideally positioned because it has an amazing infrastructure. The sites that they have in Reading and elsewhere are really amazing state-of-the-art facilities. And so Rutherford is well positioned. The challenge has been really building up a stronger relationship with the NHS. And that's something that we've worked with the company on over the course of the last year. And there's still further work to go. So the company could have a very good and strong future, but at the same time, it really has to start to, or has to continue to rebuild that relationship with the NHS to get the patients to come through Rutherford as well as staying in the NHS.
Did COVID have an impact on it in terms of, because they're talking, COVID's supposed to have an impact on a lot of sort of ongoing treatment for conditions. Did that affect Rutherford?
It did. It affected both positively and negatively. So on the negative side, there was a spell when people were not really able to interact with each other very easily. Most of the Rutherford sites, they were able to stay open, but of course there weren't as many patients being able to go to them. Furthermore, the NHS has reduced the number of diagnostics, and so therefore fewer people are being diagnosed with cancer. So that has been a bit of a challenge. Furthermore, the people who have been diagnosed with cancer are often a bit later. So they're all the challenges. The positive part for Rutherford is that when the NHS was rightfully making sure it took care of all the problems with COVID, the NHS looked to the private sector and said, who in the private sector can help us? And Rutherford was one of the companies that stepped forward and took on a number of NHS patients into the Rutherford locations. And that was really good dynamic because that really helped to continue to strengthen the relationship between Rutherford and the NHS. So therefore, COVID, I would say, was both good and bad for Rutherford.
Okay, cool. I'm sorry, I interrupted your flow. So let's go back and talk about the new positions that you've made. So
Perfect.
Yeah.
Yes. Okay. So we've got 3 slides about the new investments. We've got Revolut, Tessian, and Johnson Matthey. Revolut was actually the second new investment, but it's the one that we tend to talk about first because it's the one that most people know about, and it's certainly the most high-profile company. So I guess the first question is, what is it? So Revolut is, in our view, one of the very few global champions in the fintech space, and that really is quite a bold sentence. It is a company that has a wide variety of products and offerings, and it provides those on a worldwide basis. There are very, very few fintech companies that have a wide selection of products and provide those wide selection of products to many different countries. There are quite a lot of fintechs who focus on maybe one product or one solution, or they focus on one geography. There's very few who cover multiple. And that's where Revolut really stands out. Its heritage and where it was founded on was on currency exchange. But it's really evolved to do things like you can pay your salary into Revolut accounts and you can get some money early if necessary. It has credit cards, it has crypto, you can buy stocks, you can buy commodities, you can do international transfers still, because that was the original part of the business. You can also do insurance, as well as many other things. So it's a near full service fintech offering capability. The difference really between Revolut and most of the others is the success and its growth rates. It recently had a financing round which we joined. You can see here that was valued at 33 billion. This was the second highest valuation of any European fintech company. And it really is, this and the other company are the two European stars of fintech. We've listed here the financing rounds of A, B, C, D, E. For full transparency, we have been investors into this company through our venture funds in each of these rounds. So we joined Series A and Series B and Series C and Series D and Series E, and we've invested in Revolut both through our venture capital funds, as well as through the venture capital managers, as well as directly as a direct investor. This is really important, and I think this reflects how we work. We source our attractive investments in the private space through our deep relationships with some of the greatest venture capital firms out there. And this includes the likes of Index and Sprints and Balderton, etc., who were early investors in Revolut. On the right-hand side, on the top of this page, we do list the top 10 companies as presented by the Times. And here you see Schroder's Capital has actually invested in 3 of them. We have 2 of them in SUPP. So Revolut and Atom Bank are 2 of the top 10, and the other one, Rapid, is in the SBO, the Sister Investment Trust, SBO. So fintech is a segment that we really, really love. It's a segment that we have a lot of experience in. We have a lot of investments, not just in the UK, but on a global level. So we do a lot in the US. We were very early investors in companies like Alibaba, etc. In China. We've been long-term investors in many exciting businesses in China, in the US as well. So venture overall and fintech is a segment that we know, I'd say, almost inside out. So that's the story of Revolut.
How much of, just a quick question, how much of Revolut do you own across the whole of Schroders?
So we haven't put that number out in the public domain, but we can say it's in the hundreds of millions. So okay. We're a pretty sizable investor.
Good stuff. Tessian.
Yes, indeed. So maybe one last point actually on Revolut, and this is the one kind of thing that we've said about this investment trust, SUPP, and just to make sure people know how we think. If we had been running this investment trust from the beginning, and if we had capital to invest from this investment trust for all the last 2 years, being very transparent and not using the benefit of hindsight, we would have come in Series C. We probably would not have put this investment trust into Revolut at Series B, because at that point, Revolut was still quite risky. But we looked back at all of our documentation and our thought process at the time, and Series C would have been the time that we would have been able to put this investment trust into Revolut if we had been managing the trust for a period longer. So just so people can see that our philosophy for SUPP is to really invest in the BCD rounds. This one is a bit later and coming in Series E. But it really is a great opportunity because it's such a star company. So sorry, yes, you said about Tessian. So Tessian is a company that where many people have heard of Revolut. I imagine almost nobody has heard of Tessian. So Tessian is a company that provides security for emails. So if you think of most big corporates and medium-sized corporates, and you think of cybersecurity, the weak spot for most corporates is actually the email system. If you think of where hackers and where viruses get in, it's generally more often through email than through any other kind of access point. And so Tessian has got a world-leading state-of-the-art cybersecurity solution to protect email. Its solution is now actually in place in over 300 multinational corporates, but importantly, they are across a variety of different sectors. So this company has a lot of resilience. If, for example, healthcare has done quite well in the last couple of years with everything that's happened in COVID, and so healthcare companies have been growing. At other points, it may be that a sector doesn't grow so fast, and so Tessian has been very smart in the way it makes sure that it has clients across a variety of different sectors. The venture capital managers in this company, Sequoia, Accel, and Bolton, are three of the great names of venture. We joined this company a couple of months ago in the Series C financing. We put in £5 million, so this is at the bottom end of our range, and the reason for that was because this was our first private deal. It was a highly access restricted round, and we're really excited about where this company can go from this point on, considering its security, its email security system is really state of the art and is getting a lot of traction with larger corporates as clients. The last new investment that we'd want to highlight is Johnson Matthey. This is an investment on the public side. If Roger Doig, my co-portfolio manager, was here, he would talk about how this company is a very robust, strong, and stable company, maybe a bit more than words like disruptive or innovative. Now, that's not to say something too negative about this company. It's more the fact that given the back history of the investment trust, we want to have public companies where they are generally liquid public companies and where we can buy into the companies or sell out if we need to, but where there's still considerable upside if we choose to hold these companies for many years. And Johnson Matthey, we think, really fits that perfect middle ground, whereby we can get in and out if we wish to. So there's no problem on liquidity, which was the case for some of the former public companies in the trust. But at the same time, it's one that's got a strong position from this moment on, if you look at what the company does and how it works. It's one of the leaders for low cobalt cathode materials for electric vehicles. And I'm sure many of you will see how electric vehicles are massively increasing in popularity. We think this is a long-term trend, not just as kind of a thematic trend, but also with all the government regulation about stopping the sale of petrol cars and diesel cars at some point in the not too distant future. The last couple of slides are about what we want to do ourselves in the future. Just conscious of time to make sure that I don't take too long. The slide here, 12, really talks about what we like. I must say it has a number of buzzwords like best disruptive innovative companies, like institutions of the future. For us, I think the way we look at it is really that the phrase on the left-hand side is we want to back the very best British businesses, whether they are public or private. There's a lot of innovation, there's a lot of disruption going on, driven by both the scientific development and technology development in the UK. The UK is able to create globally important companies like Revolut, and we want to be able to provide access to those companies while they're still private to investors, to the retail investors, because we think it's something that isn't available in most other investment trusts.
Do you feel there's a need to differentiate the two funds, to put a sort of like a hard border between them, or can you see a situation where they end up merging?
Yeah, that's a very fair question. So I don't believe they'll merge. There's two reasons why I don't believe they'll merge. The first is they do have a subtly different strategy. The second is the different back history, different sizes of them doesn't make sense. So the strategy for SUPP is more venture and growth, and for SBO is more growth and buyout. We also will be making a different number of investments in both vehicles. For SUPP, we're going to be making 3 to 4, maybe 5 private investments in a year. For SBO, we're going to be making 15. So the volume of new investments is different. Furthermore, the public-private ratio is subtly different. So in SUPP, it is the long-term plan is 75% private, 25% public, whereas for SBO, it's nearer 50-50. And we felt that was particularly important because we just launched the IPO of SBO. And so we wanted to make sure we got the capital invested quickly with SBO. And so actually, it would normally take a long time to do if you were doing it only in private. If you want to get the best deals, I mean, people can invest anywhere at any point if you want to invest in every deal. For us, the key is to invest in the best deals. And so we didn't want to just park the money in public. We really want to actually find the best deals in public as well. And so we said that if you want to have the long-term philosophy of finding the best deals, then you should start with 50-50 and aim for that as a long-term strategy. So there's a slightly different nuances to the two vehicles.
Okay, cool.
The next slide really talks about where we're going with SUPP. It wasn't inherited, but we didn't inherit the portfolio. We've changed it a lot. It's quite interesting. The industry background doesn't, and the public-private background doesn't look like we've changed it that much. But actually, the dynamics, they're fundamentally different kind of companies now. They're very few companies are pure venture loss-making companies where there's going to be 5 rounds of financing. They're now far more robust companies. What we've said for the long-term future is we do want to move it a bit more away from healthcare. We love healthcare. As a Schroders Capital team, we do about 30% IT and about 30% healthcare. So they are our 2 dominant sectors. But we feel that for this investment trust, the challenge with doing too much healthcare is if you look for biotech investments where you're in a round that can have many biotech investments are loss-making and many of them can be write-offs. Given the back history of the trust, we don't want to put in lots of companies that can be write-offs. We want to put in companies that are a bit more robust and stable and stronger, but still retain that innovation and disruption. And so therefore we're going to, if we look at the long term, we're going to rebalance the portfolio slightly by industry. We do want to retain or have a ratio of about 75-25 public-private. This is slightly skewed at the moment by Nanopore being such a successful IPO. I'd say it's a problem to have, but it's a very good problem. And so it's not really one that we're going to worry about too much, because as long as you've got access and you invest in some of the great companies that are still growing, that's the more important topic than whether it's 75-25 or even whether it goes to, say, 60-40 for a short period of time. And then the final slide has a few points about where we want to take the portfolio in the future. I think really if I want to pull out 2 or 3 points from here, I want to say that the first point is really important. We believe really strongly in supporting the existing portfolios. There were some companies we clearly had not chosen, but by moving them into the right path, we feel they're now on the right journey. There's still more work to be done on some of the companies. We've managed to sell off some of the positions that we were maybe less keen on, but we really have to continue to work with the existing portfolio, whilst also, and this is where the second point comes on, making new portfolio investments. We've got a really deep pipeline. The quality of investments, both on the public side and the private side in our pipeline, is really, really deep. And so we're really excited. We're very conscious, though, that we want to make this trust to be seen to be a leader in responsible and sustainable investment. It's something that Schroders itself talks extensively about and we feel passionately about, and we feel that a kind of a quite high profile visible investment trust is a good way to demonstrate our capability in responsible and sustainable investing. And so we use the United Nations SDGs as part of our investment criteria, and we're going to carry on doing so. There is also a big piece of work to be done to reduce the discount to NAV. That work is being done mostly by our full investment trust team. Schroders runs more than a dozen investment trusts, and it's certainly been very good to work with them, because they're really long-term experts at working with investment trusts to reduce the discount, and that involves around communication, et cetera, as well as potentially share buybacks. So that's the last part that we're working on. We're kind of expecting to do more on over the course of the next year or 2.
Oh, all right. I think actually Oxford Nanopore is going to help no end in terms of like seeing the kick up in NAV. That's the sort of thing that normally gets investors excited. Is there anything else that you're doing to work on the discount?
So it's quite interesting, actually. We did believe that the story around Revolut would make quite a big difference, because this is such a high quality business. What we realized after doing the communication around Revolut is actually, despite the fact it is a globally important company, it's maybe not recognized in the UK as well as perhaps it's recognized globally. And that's actually part of the reason why some of the big international investors came in with such large sums into the company, because it really is a magnificent company. So I think there's still more work we need to do about why we do the investments we're doing. But on top of that, we want to really emphasize the work that we've done on the existing portfolio. For the first 12 months that we had this trust, we made almost no announcements. It almost felt like we were kind of scurrying around under the water, fixing things without saying anything, without putting our head up and talking about it. During the course of this year, as some of the work we've done has become visible, like the Kymab exit, like the Rosetta basket sale, like the Immunocore IPO, now things are becoming more visible. We're starting to talk a bit. Our view has been do the work and then talk. I think we could do a bit more talking about what we're doing because there's been so much progress within the trust. So I think if we talk about, therefore, the success of Nanopore, if we talk about our existing investments, or sorry, our new investments, and we talk about the work in our existing investments, hopefully they should do a lot of the work to reduce the discount. We do also work with the board and talk to the board about whether there should be share buyback options. At the moment, our pipeline is so full with such quality deals. It's a bit of a good discussion, as I'm sure you could imagine, between the two options. At the moment, we've prioritized making new investments. We'll see if we're going to counter that or maybe even do both. But that is, of course, an option that we can do.
Cool. One question's just popped up here. Can you just talk a little bit about fees and performance fees in particular? I suppose also Nanopore might be relevant to that.
Yes, indeed. So when we took over, I've got to remember exactly where the share price and the NAV was. The share price was around 30p and the NAV was around 40p, plus or minus. I'd have to go back to the files to check. What we said, though, is we would only get a performance fee if we got the NAV back up to 77p. And we assumed, therefore, if we got the NAV to 77p, the share price would follow, or at least be somewhat linked. So we said that as a vocal statement when we took over the portfolio, that we would need to get the NAV back up to 77p. We're obviously not there yet, but you could imagine that's one of the reasons that we're doing so much work with the existing portfolio. We felt at the time, or we knew at the time, if we were only to sell off everything and that would have been selling off everything at a big discount, and then make new investments, it would take too long to get back up to 77p. So we wanted to make sure that we were working with the existing portfolio, and we have made sure that people know that the number is 77p. So it's a little way away. We've got a very big team working on this. But at the same time, we knew it wouldn't be easy when we took over the trust.
Yeah, cool. Well, good luck with it, really. Thanks very much, Tim. Run a little bit over time, but I think it's definitely interesting. So we'll follow up. I think we're going to talk to Schroder UK Opportunities in a couple of weeks' time, actually. So let me just have a look. We've got our list of what's coming up. Yeah, there we go. 5th November, Rory Bateman. So look forward to that. And sticking with the private equity thing, we're going to talk to OK Capital again next week. And so I'll be back and we'll see you then for the 8th of October. So thanks very much to Andrew and to Tim as well. And I'll see you next week. Thanks. Bye-bye.